Hi, my name is Jason Cruz, and I am a senior in college majoring in accounting and finance. I'm currently an intern for Titan Capital Management at my college, Cal State Fullerton, as an equity analyst intern. I have no major designations like the CPA or the CFA, which essentially means I have no place in giving you professional investment advice. But what I can do is share my own personal investing philosophy based on what I have learned so far. I personally own a portfolio of stocks, and no, I'm not going to show you my individual positions, what I'm going to be investing in. I'm going to save that for a different video. Instead, I'm going to break this video down into 3 parts. And before we get into those 3 sections, it is important to know that these 3 sections that I'm going to explain really helped me build the foundation and confidence to invest in the stock market. So let's get into it. The first one is a diversity. A simple way to explain this is to look at your individual income streams. Let's say you had investments in stocks and a side business in conjunction with that job that you have already. That means you have 3 income streams. So when you lose your job, and trust me, it can happen at any time, you have 2 other income streams, your stocks and your side business, to help you keep on going. So let's take those 2 scenarios and apply it to investing. You do not want to own just one stock in your portfolio. Instead, you want to own many stocks, because when your stocks lose, and trust me, you will pick losing stocks, it happens to everyone, you have some winners to balance out those losses. Second is going to be dollar cost averaging. So before I get into dollar cost averaging, I want to kind of explain the 2 other investing methods that go along with dollar cost averaging. So the other 2 are going to be market timing and lump sum investing. Market timing is when you try to time the low points and buy then, and then high points where you try and sell. The problem with this method is that it is almost impossible to predict exactly when the market is at its low and when it's at its maximum peak. Many people like to believe that they have the ability to do so, and don't get me wrong, there are people that can, but it's a very select few pros that can actually do it, and more losses have arrived than gains when trying to attempt this method. It is actually common for some first-time investors to dump a whole bunch of money into one position because they think it's at its low point and it's gonna bounce back at a really high point. And unfortunately, sometimes investors lose so much money that one experience keeps them out of the market completely because of that bad experience. Lump sum investing is when you take the money that you've allocated to start investing and you dump it all in one time. Let's say you buy many stocks to just invest. Not to be confused with market timing, because in market timing you have a very short oriented time period where you buy and then you sell within, I don't know, maybe a day, 1 week, 2 weeks, whatever. Lump sum investing is when you take whatever amount of money that you have, you dump it in, and that is it. You just keep it in there. Statistically speaking, this method actually does come out ahead out of the 2 other investing methods. It actually beats the timing, market timing, and it beats the dollar cost averaging. 2/3 of the time, lump sum investing actually comes out ahead, outperforming any other investing type of method. However, I do not recommend this type of investing approach because you tend to see very high volatility, and when you're first starting out in investing, there is some level of fear that you have, some speculation that you have about investing in the stock market. If you already have fears about losing money in the stock market, then lump sum investing could probably multiply that fear by 100 because of that volatility. For example, let's say you had $10,000 to allocate to investing, and you go ahead and dump it into a diversified portfolio of stocks. It is not unheard of for markets to move 5% within a day, so losing 5% of its value within a single trading day, which means that your $10,000 investment could lose 5% of its value, or $500 in a single trading day. If you already have fears or speculations about investing, seeing your account drop in a single day of $500 could really make you uneasy about investing. So our solution between these two different investing methods is to dollar cost average, which essentially means to invest over a period of time consistently. Let's say you have the same 10 grand. You could dump $1,000 of that into a particular set of stocks. Once you do that, you could see how often your money moves up and down, because the stock market can be volatile at some periods in time. Once you understand that volatility and you feel comfortable losing and gaining that type of money over time, that's when you can add in to your original positions. So as an example, let's go back to the 10 grand. You put away 1,000 into a set of stocks. You've seen the volatility that can happen, and then you feel comfortable investing a little bit more money. From the 9,000 that you saved, you can pull out maybe $100 every week and start investing that into more and more stocks to build that portfolio even further. This way, essentially, you get to average out your prices, because you will definitely be buying at different prices at different times every week, every month, whatever it is you choose to do with your investing philosophies. Finally, this is probably the most important one, and something I had to really learn for a while, and that would be to stick to your goals. I have learned that when you make a plan and you stick with it, it tends to pay off in the end. A month ago, when the stock market was in free fall due to uncertain economic conditions caused by COVID-19, my personal portfolio, dropped $1,400 in value. I never sold a single stock at that time, and instead I continued to keep buying at the low prices, well, at least what I thought to be low prices. I have since recovered that $1,400 loss, and I also have a decent amount of gains to go along with it. My plan when starting to take investments seriously was to build a portfolio of stocks that I would keep in the long term so that I could build an income stream in the future. My goal is much more future oriented, while yours may not be. Whatever your objective is with investing, my advice is that you establish that objective and you stick with them. Well, that pretty much wraps up for this video. If you guys enjoyed it and would like to see more content like it in the future, please hit the like button and consider subscribing to this channel. I'll see you in the next video. Peace.